After the historic jobs report, we look to the Fed. Will they go from slightly dovish to hawkish after the stellar report by tightening further? Will inflation begin to rise again? Where then are the opportunities for fixed income investors? We'll find out right now here on UBS Trending. Welcome, everybody, to another episode of UBS Trending. I'm Anthony Pastore, and I'm here with my fantastic colleague and friend, Leslie Falconio. Leslie, what a head turner on Friday with that jobs report. Incredible stuff.
It really was. I mean, not only was the job strong in terms of the actual amount of over 500,000 jobs, but when you think about how much it turned in terms of the market's perception, and you'd mentioned this, we were talking about this earlier, is that when the Fed met on Wednesday, the market took the conversation as what we call dovish, right? Mm-hmm. Meaning that they were probably going to stop soon. They would ease in the second half of 2023. That was the market's projection. The Fed is still, moved the pace down, but they made it clear they're going for longer. So you had sort of this, what we call sort of this chase for risk assets on Wednesday, meaning that the equity market went up, high yield markets sort of outperformed, and then on Friday, you have this, over 500,000 jobs report, and everyone went, wait a second, now what? They are going to be higher for longer, for maybe a period of time more than what we originally had thought.
Right, well, that's the question, right? At a 3.4% unemployment rate, which is a 53-year low since 1969, May 1969, we haven't seen unemployment this low. Like you said, 517,000, which, by the way, was well above consensus. Analysts were expecting 188,000. So it's almost triple what analysts were looking for. You have to wonder, will the Fed need to turn hawkish again? Because the question is, will inflation start to heat up? If that many people are having jobs and they're not going down as everyone was expecting they would at this point, what's next?
Well, I mean, that's interesting because to your point, I mean, the 3.4% is like the lowest since like 1969 or something.
1969, yeah, 53
something like
years.
That. And not only that, but the participation rate went up, so people actually entered the workforce.
That's right.
So in other words, the unemployment rate didn't go to 3.4% because people stopped looking for a job and people fell out of the workforce. The participation rate actually went up. So I do think when we take a look at where we're going from here, I think the market now is a bit more correct in terms of what it's pricing in. And what I mean by that is that they are following really that Fed guidance of what Chair Powell had said in December, that I have to admit the market has somewhat completely ignored the first month and a half of the year. But now the market is pricing in, what? You're going to pause, right? We might have another 25 in March, another 25 in May, and you're going to pause, but you're going to hold that pace for longer, and you're not going to ease in 2023. And to your point, I mean, if in fact we have this 3.4% unemployment rate and it stays there, you have to worry whether or not wages go up, right? There really isn't. I mean, one of the biggest issues that Powell is facing is that he has this supply-demand imbalance in the labor market, right? We've seen this with the data. And in order for him to create what we call demand destruction, right, and to bring inflation down, he needs to bring that, the labor market down or the unemployment rate up.
That's right. I mean, if you're looking at CPI, we don't get the next consumer price index reading until the 14th, Valentine's Day. So we're looking still at December's, and it was at, 6.5, 6.4%. Which is down from 9.1% in June. So we know that inflation has been steadily moving lower, but there are a lot of economists, or I should say even more than that, is the investors out there who are looking to experts like yourself and our economist, Brian Rose, and saying, well, could we see inflation tick higher? The only thing there is that we did see that wages actually are slowing down a little bit over the past 12 months. Average hourly earnings were 4.4%, which is down from 4.6% a year earlier. So people are making a little bit less per hour. But there are still so many people who have jobs, despite all the layoffs we are starting to see in those technology companies that we're seeing.
They are. And plus, when you think about the average hourly earnings, is that there's a lot of mixed data in there. It's great to look at, but you have to look at what we call the ECI, the Employment Cost Index as well. Although, to your point, it's falling, but it's well above what the Fed objectives want to be. And same with CPI. There's no question that CPI has been declining, right? He mentioned disinflation, I think, in his speech like 16 times. But you're not at the level where the Fed wants it to be. So there's things within CPI that are declining, but there are others that have been what we call a little bit more sticky, that really aren't falling at the pace that they would like to see. And until they have that, until it reaches part of their objective, which is 2%, and by the way, I don't think they're not expecting 2% this year. They're expecting 2% over the longer term.
That's right.
Right? So until they see that, it's hard for them to really start. They could pause, but I just don't really think they're going to ease unless we see a large correction in the labor market. And that means, I'm not talking about next month's job report being below expectation. It has to be several
That's right.
that are really below.
Yeah, I was going to say the past performance is not an indicator of future performance,
Right.
but you can't expect that it's going to be a significant, drastic difference between Friday's number and the first Friday of March when we get that data.
That's right. And this number, even though, listen, there's points in this number where you can excuse whether it's seasonals or construction, warm
Sure.
weather, and the strike being over and some of the education. But still, this is a number where even if next month we get a weaker, the market's not going to forget it, right?
That's
It's
right.
going to stay with them for a while.
Even Brian Rose, our economist and CIO, did indicate that there's some noise in the number from
Yeah.
Friday. And that's what he was talking about, seasonal employment, et cetera. But it's still such a blowout number.
And the three-month average is about 350,000.
That's
I
right.
mean, that's not, really weak compared to where we are now in the cycle.
So here we go, right, Leslie? So obviously I want to get to the point where we discuss opportunities for investors. And on our live call last Wednesday, or I should say last Thursday, I did ask you where you see opportunities for fixed income investors. What are your preferred methods of investing within the asset class today? Have they changed since that number came out on Friday?
They haven't changed since the Friday number. We really came in, and we talked about this, we came in with a slightly longer, what we call interest rate risk, meaning that we came in expecting that yields would come down a little bit. They came down much quicker than what we thought, right? You started at 380 in the beginning of the year. You went all the way down to, say, a 335 after poor retail sales and on Wednesday. But we've kind of been in this range of 340 to 390 since mid-December. But volatility has dropped tremendously. And when volatility drops and you have yields coming down, that's a great environment for fixed income. It's a great environment for risk assets, right? So when we think about our positioning, is that what we've done is every time the yield, that 10-year yield has gone down to 340, we've kind of taken some interest rate risk off the table. And I want to clarify, because I'm still bullish. I still think 10-year yields will come down by the end of the year to about 3%. But to come down this fast, and one of the reasons why they did is because they priced in these eases. We had felt that it's a little bit too quick. Too many eases are priced in by the end of 2023, so we took off some of that interest rate risk. We've had this higher quality bias, and all fixed income risk assets have done well, between whether you're the lowest of quality to things like agency mortgage-backed securities, which are AAA. All these spreads have compressed now. So when we look at today, where we would be is that, if you don't have anything in fixed income, okay, you want to wait a little bit because we do think spreads will widen a little bit. You could see interest rates rise. We're at 360 now in the 10-year yield.
And that's since the jobs report.
That's right. So we can get to 380. But then you want to maybe start adding that higher quality because, spreads have compressed tremendously the first 6 weeks. Now, both high yield and investment grade corporate spreads are back to the April 2022 levels, right? And remember, in April 2022, the Fed had just tightened 25, and they just had finished increasing their balance sheet. So this is like, we're back at spread levels like 425 basis points ago of tightening, right? So we've had this huge move to risk assets, which again, I mean, when you have volatility drop, knowing that the Fed is going to pause, right? The debate is over the ease. So now that they've removed a little bit of the easing because of the strength in the labor market, you might see a little bit of widening. But you should take advantage of those spread widening by going into higher quality like investment grade corporates.
Right, high grade investment grade corporates. That's where you'd be putting your money to work right now.
Right.
Terrific. Leslie, thank you so much. It's always good. And remind us, so you think by the end of this year, we'll have a 10-year somewhere around 3%? Despite this little rally in yields that we've seen.
It's only February.
That's right. It feels like it should be the end of the year already.
It works on a lag. So those 75 basis point rate hikes we saw are still waiting to come into the economy fully. So
a lot more for our discussions going forward, Leslie.
Right.
Always great to have you. Thanks for joining us. Good to see you, Leslie Falconio from the Chief Investment Office. So that's all the time we have for today. We hope you got a lot out of this discussion. I know I always do, especially when I'm sitting with Leslie and other members of the CIO. So in the meantime, everybody, for more information on what we talked about today, make sure to follow us on all the different social media platforms, plus all of our other content, which can be found on ubs.com/views. A lot of CIO content up there as well. Plus, all of our past UBS Trending episodes can be found on demand by going to that website as well and visiting UBS Studios. And if you do have any questions about your own portfolio based on what Leslie and I spoke about today, make sure to reach out to your own financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everybody, and remember to keep your eyes on what's trending. We'll see you soon.